Are you a broke loser? Do you want to stop being a broke loser? Well, buy my book on Amazon. It's $2.99 for an ebook or $9.99 for a hardback. It's called Stop Being a Broke Loser. If you buy this book, you will no longer be a broke loser. So buy it now. Welcome back to Strongman Personal Finance, everybody. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser, and lover of everything money software. Now today, we're going to talk about when I would buy Intel Corporation, the hot stock that all these value investors are deliciously falling in love with. And it's not a bad stock. However, I'm not going to buy this stock unless it drops to $42 per share. Now you may ask, why? And we'll get to that. So let's go. Let's look at Intel. Look at some of the fundamentals. So, market cap, $218 billion. Pretty big company. Price to sales, 2.8. Not that bad. Price to earnings ratio, 11.77. That's pretty freaking low for this market. I mean, you got PE ratios for staples like Walmart in the 30s. So to see an 11 PE ratio, it's pretty freaking nice, okay? Profit margin, that's very high profit margin, which is the bottom of the income statement. Basically, if you look at like a retailer like Walmart, their profit margin is like 2%. They're making 23% at Intel. That's pretty freaking good, okay? Gross margin, 55%. That's, you take your revenue minus your cost of sales. It gives you your gross profit. Divided by your revenue is your gross margin. So they're making a pretty hefty profit off the chips or whatever that they sell. It's pretty freaking good. Return on invested capital, return on assets, return on equity, they're all pretty good. 11% for invested capital, almost 10% for return on assets, and 23% for return on equity. I mean, not bad, not bad. If you're looking at it just from that standpoint, it's a pretty good stock. However, you have to actually see if the price is, at or below or above the company's intrinsic value based on your assumptions and based on your required rate of return. So let's go look at the income statement. Just like Daddy Paul does, he looks at revenue growth. So, going back, 9-10 years, $54 billion, and now we're at $77 billion. And even going back over the last couple of years, there's been revenue growth every single year. So, this is not a dying company. Gross profit has also, gross profit went down in the 6 months ended, or the year ended 2021 June, compared to the previous year. Wonder why that is. Wonder if that's a long-term problem or just a temporary thing. Interesting. Net income, we also had profit. Profit's generally been going up, but I guess there was like a fluke year that ended in June 2020 because the net income for 2020 was $23 billion. And then the revenue went up the next year, but the profit dropped to $18.5 billion. So that's pretty interesting right off the bat. And I don't know if that has to do with the gross profit or if there's something else in here that potentially could have made that happen. You got to do your research, okay? I'm not telling you to buy the stock. I'm telling you how I feel about it, okay? Balance sheet, I guess this is where they have the, where is it? They have the shares outstanding somewhere. I can never freaking find it in the software. But, I know they're buying back shares, so whatever. So overall, not bad. You look at the 8 pillars, all 8 checks. That's pretty freaking awesome. However, it doesn't matter if there's all 8 checks because you need to go to the stock analyzer tool. You need to put in my opinion, conservative assumptions, and then you need to use a discount rate, which is what profit you want to get to give you the price to buy the stock at. In my humble opinion, I start at 15%. So I put my low, middle, and high assumptions here, and I chose my desired profit, my desired rate of return to be 15%. And that will give me the price that I should pay for this stock to get a 15% return, okay? So if we zoom in a little bit, I was pretty conservative with revenue growth. I said low end of 0, high end of 4%. Share change, they've been buying back shares very consistently. So I said low of 2%, high of 4%. Profit margin, low of 20, high of 25. It's pretty reasonable. Price of free cash flow, 19, 20, and 21. Or sorry, free cash flow is a percentage of revenue. And then a pretty low PE. Right now their PE is 12.41. Even wasn't that different on the metrics? Yeah, the PE here is 11.77, and on the stock analyzer tool, it's 12.41. That's interesting. I wonder if there's some kind of issue with this. But anyway, so the PE here is 12.41, which is also pretty freaking low PE ratio. Now, with my conservative assumptions of 8, 10, and 12, that's pretty low as well. So, I mean, if you bump those up, the higher that you bump up your projected price to earnings ratio, the more easy it is to convince yourself to justify to yourself to buy the stock. Because the PE multiple is what determines the share price based on the projected earnings in the future at the time that you would potentially sell the stock, okay? So, like I said, my desired annual return is 15%. So I analyze it, and then we have my assumptions here. So to get a 15% return with the low assumptions, $30, $28, I think these are pretty freaking low, okay? No revenue growth, very small share buybacks. I mean, they probably buy back more shares if revenue flatlined. Lower than average profit margin, 19% free cash flow as a percentage of revenues. I mean, these are very conservative, very, very conservative. Now, why I said the middle is I think the middle assumption is a little bit more reasonable, where the company grows at 2% annualized over the next 5 years. It's pretty reasonable for a large company like Intel. 3% share buyback, profit margin 22.5%, PE of 10. I mean, those are all pretty reasonable to me. You can always disagree, okay? But if you do that, you can see based on the discounted cash flow value, your 15% buy point would be $39, and for a multiple of earnings, it would be $43.99. So in my opinion, I said, okay, I'm just going to choose the middle. I'm not going to just go off one value. But if you want to be really conservative, you could use the lower of the two. It's really up to you. Or you could use the lower of the low, but that's kind of ridiculous. And that gives me roughly a share price of $42 that would give me a 15% return. Now, I know if you raise the PE ratio to 15, for example, if that's what your future PE is going to be, boom, it makes it way easier to justify buying it right now. It's basically almost looks like it's priced for my middle assumptions at a 15 PE ratio. But that seems kind of high to me for this company, 5 years down the line, but you never freaking know in these crazy markets. Anyway, so yes, I personally, based on my analysis and based on my desired rate of return of 15%, I would buy Intel if it dropped to $42 a share. Now, if you want a lower return and you have different assumptions, maybe your buy point is different. But that's the thing with investing, ladies and gentlemen. If you're going to buy individual stocks, it's personal. You can't just look at other people and be like, oh, they said this. You have your own required rate of return. And some of you, if you just love individual stocks, whatever, buy whatever you want. But I personally invest 95% of my money in total world index funds in tax advantage accounts. And I leave 5% to look for opportunities like potentially Intel Corporation, okay? Because I'm not going to risk a huge portion of my capital buying individual stocks because you're not diversified from, I think it's called idiosyncratic risk, which is the risk of an individual stock for whatever reason specific to that stock, making that stock crash, and basically defying all expectations. So that's my thoughts. I would buy it at 42. That's my humble opinion. I mean, it's not a buy. It's not a bad buy now. But, I mean, that's ultimately up to you to determine. But that's it, ladies and gentlemen. Like, subscribe, tell your friends about me, and y'all have a wonderful, delicious night. Choo!